Hi everyone, this is Jason Burek of Wall Street for Main Street, and today is Monday, July 5th, 2010, and this is your weekly commodities market wrap-up with a preview of the week ahead. Last week, on Friday, there was an abysmal jobs report released. Let me break down this jobs report really quickly for you and give you all the pertinent facts, quick summary of everything you need to know. Here's the bottom line. The bottom line is only 83,000 jobs were created last month by the private sector. This is the first month all year that payrolls dropped. For about 4 or 5 months, payrolls have been on the way up slightly. Now, as many of you know, this was mostly due to temporary census workers and the birth-death model. But the results for this past month's one of June were so bad that they couldn't even paper over them. So here's the main breakdown. We need to create 150,000 jobs a month just to break even so we don't have even greater unemployment because there are that many more people entering the workforce. So when we only have 83,000 total jobs created as opposed to on average about 112,000 of the prior months before that in 2010, then you have a humongous problem. Okay? So I expect the jobs reports to actually be worse unless they come up with more jobs bills in Congress and stuff like that. From a technical standpoint, the Dow, the NASDAQ, and the S&P are, because of the jobs report and also because of the technicals, the jobs report would be a fundamental reason, are looking like they want a crater. We will see if we get that crash or not this week, probably, maybe as late as next week. There could be a bounce. I was told with a friend, talking with my friend Dennis, that Richard Russell of Dow Theory thinks there will be a bounce. But I also heard on some experts, technical experts on the Financial Sense News Hour, that there will not be a bounce and that we are going to attempt to crash here. But we'll see. You never know with the technicals here. It could go either way. Technicals, there's a lot of head fakes in technicals, and one indicator will say one thing and one will say another. Many of you traders already know this, but the people who are unfamiliar with trading will not know this. On to the precious metals. Gold last week got absolutely hammered. It went from above $1,250 an ounce to, by the end of the week, it went to $1,210 an ounce. An absolute destruction. This was on really no fundamental news whatsoever. In fact, there are now rumors on Wall Street that the Fed, after seeing the M3 and the other stuff out of the G20, and Ben Bernanke and Obama are panicking at the M3, because Obama has now been meeting with Ben Bernanke literally every day. He's been on the phone or in private discussions with Ben Bernanke every day, which is pretty rare. So the rumors now on Wall Street are that the Fed is getting ready to double its balance sheet. Heard these from multiple sources over the weekend, and it will be interesting to see. But that would be bullish for gold because that means the Fed's going to be monetizing more debt. I don't know, more cash for clunkers programs, more unemployment. I don't know where the money's going to go. We know the states are bankrupt because even CNN last week was running a segment on CNN talking about the states being bankrupt, which is pretty rare for the mainstream media because, I mean, mostly they really don't get it or they intentionally leave it out. Doesn't even matter. But the precious metals markets in general, I'm going to use the M word. There's definitely manipulation there. These guys, these banksters, these bullion banks, all know precious metals in the long term are going higher, but they all in the short term want to make as much money as possible, killing people who are the technical longs on the COMEX there, who are buying the futures, the commodities futures and other stuff. This is why you should not N-O-T, be buying commodity stocks, mining stocks, and also futures contracts, in my humble opinion, on any margin. If you are going long silver futures, try to pay all cash. If you are going long commodity stocks, pay all cash. If you want a hedging strategy, I would use options to hedge. You can buy puts to protect yourself downside and go long. That will cover yourself. You can buy puts or insurance. You can buy, it's a married put, where you go long a stock. You could buy 100 shares of a company stock, say a Newmont Mining or a Silver Wheaton, and you could also buy a married put at the same time to give yourself downside protection that will provide insurance. That is an interesting trade. It will require you to pay a little bit more money up front, but it will give you peace of mind just in case things crash because the put will become worth a lot of money and you could sell it and then buy more stock or whatever.
So that is an option there. That's not a recommendation, obviously. Do your own research, but that's just my opinion if you want to get long at this point. When I have more cash, as I've stated before, I'm a buyer on any dips like this. I should be buying some more precious metal stocks or some more physical silver very shortly. Oil, I heard one technical analyst say it's going $60. It's going to test the lows at $60 a barrel. If it does, I would be smiling here. And if you plan on buying the oil stocks or oil futures or whatever in the oil market, I think if it goes to 60, I think it's time to start a position for sure if you're not already involved. And if you have more cash on the sideline, you're waiting to add to your position, I would love it to go to 60. Like I said, the production costs are one of the key here. A lot of these companies just cannot produce oil profitably, especially if you're a deepwater offshore drilling company. Anywhere in the $55 to $60 a barrel range, you really cannot produce oil profitably. And a lot of these companies are relying on a humongous amount of deepwater offshore drilling still, moratorium in the Gulf or not. So around there, I would be looking at a lot of the oil and gas guys. I personally, long-term, really like the picks and shovels companies, any of them really, I think, because those guys are going to get paid to drill and help pull out oil or even look for it no matter what. And I also like the Canadian oil sands companies now, as the American government and Obama continue to fight in the courts for the moratorium there to fight the Gulf. The Canadian oil sand plays and the stuff in the Bakken become more attractive. So you can look those companies up. If you drop me an email, I can give you a list of some suggestions. As far as this week, I would pay attention to whatever treasury auctions are going on, and I would study the technicals and watch the technicals. I really don't expect today to be this week to be a heavy volume week, so we could get an upward rally or a downward crash on low volume. If it's on high volume, either way, it could be a warning signal. Normally, high volume signal a reversal in trend. So if it's going up, so because the long-term trend now seems to be down for the Dow and the S&P. So if we have higher volume on the uptrend, that would be a reversal. If we have strong volume on the downtrend, that would be that a crash might be coming. Even if the Dow does drop, I am still a believer in the precious metal mining stocks. I think the Dow to gold ratio will start tightening. I think gold is going to be going a hell of a lot higher, especially if the Fed plans on doubling its balance sheet. So everyone have a good week, and I should be out with some more video blogs. Might be doing an update on BP and the oil spill this week, like an article or a couple more video blogs. And I will speak to you guys soon. Have a great week, everyone, and I hope you had a great July 4th weekend. Bye.